I came back to let you know. Got a thing for you, and I can't let it go.
Boy Wonder, I swear it's like this every single time. Toronto, I got you. I got us. Yeah. On double MG, I fuck a rapper's wife.
What's going on, guys? It's your boy Tyler bringing fundamental analysis on a fundamental basis. Today's article is brought to you by Routers. US stocks shudder and dip after Fed minutes. Main US indices decline, Nasdaq off, most down 0.7. Common services weakest, S&P 500 sector. Utilities lead gainers. The dollar edges higher. Gold, Bitcoin dip, crude off by 2%. US 10-year Treasury yield rises to 4.25%. US stocks shuddered and dipped after Fed minutes. Wall Street fluttered lower but remained above session lows after the release of the minutes from the Powell and Company's July monetary policy meeting, which revealed a division among Fed officials regarding the need for additional tightening. The minutes said some participants expressed concerns over economic risks of further rate hikes, but most trained steadfast in central banks' battle against inflation. The notes also showed that the decision to raise the Fed funds target rate at the conclusion of the July meeting was not unanimous, and while the policymakers agreed that economic uncertainty remains high, future rate decisions will rely on data over the coming months. Here's how the S&P 500 behaved in the immediate wake of the Fed minutes release. S&P 500 companies' earnings calls in the second quarter were dominated by three themes: artificial intelligence, outlooks for U.S. economic growth, and drivers for sales growth, Goldman Sachs analysts said in a note. As of August 14th, 457 companies had reported second quarter results, representing 89% of total S&P 500 market cap, according to Goldman. Artificial intelligence, which took Wall Street by storm earlier this year after the launch of generative AI chatbot ChatGPT, was a hot topic in the second quarter for both investors and company management teams. Management teams across all sectors describe uses of AI that they currently have in place, plans that they have to invest further in AI, and how the current demand for AI technology can indirectly benefit their business, Goldman Sachs says. Brokerage adds stocks deemed to be AI winners have exhibited strong performance this year. In particular, the seven largest stocks by market caps are widely considered to be major AI beneficiaries. Another hot-button issue of the quarter was strong employment figures and low inflation data, leading the equity market to price a stronger economic growth outlook. Goldman notes that management teams' pessimism around the economy has eased to an extent. Several companies acknowledge the economic resilience has led them to expect a soft landing. Finally, comments from second quarter earnings season analyst calls have indicated that the drivers of sales growth have varied at the company level. Goldman said, going forward, its economists expect core PCE to decline from 3.4% at the end of 2023 to 2.4% at the end of 2024, adding that its inflation recedes, the pace of price increases should also decelerate and will be less of a tailwind for sales. Fed policy and the economy, there is a mismatch. In the wake of Tuesday's retail sales report and Wednesday's numbers on housing starts and industrial production, the Atlanta Fed's GDP tracking estimate for Q3 has risen to 5.8 from 5% on Tuesday. From Atlanta Fed's website, GDP now is an official forecast of the Atlanta Fed. Rather, the Atlanta Fed says it is best viewed as a running estimate of real GDP growth based on available economic data for the current measured quarter. As Mike O'Rourke, chief market strategist at Jones Trading, sees it, this is not good news for a market that is expecting the Fed to cease its tightening. According to O'Rourke, Powell and his FOMC colleagues should be hesitant to declare victory in the face of strong economic data. O'Rourke adds that Powell has repeatedly stated that the greater risk is in doing too little and allowing inflation to re-accelerate, which was the case at times in the 1970s. Meanwhile, O'Rourke asserts that the Federal Reserve is making a policy mistake in assuming that the neutral policy rate is the same low level it was prior to the pandemic. It does not take a rocket science or an economics PhD to tell us the US economy is structurally different than it was pre-pandemic. Nonetheless, the Federal Reserve is continuing the general fighting the last war. In this regard, O'Rourke believes that the policy the Fed is applying today is based on the structure of the prior economic regime and not the current one. Therefore, the policy is mismatched to the economy. O'Rourke says that throughout the current FOMC tightening cycle, economic releases have been stronger than expected, and even in the recent deceleration, there is continued strength and resilience in what most Fed officials have described as a restrictive policy environment. The data is telling the Fed officials something different. The data is asserting that policy is not as restrictive as Fed officials believe it to be, and that the level of neutral policy rate is likely higher and should be re-evaluated. Strong demand for travel and recreation, especially from Asia, could keep some areas of inflation elevated, HSBC says. Developed countries have seen sharp increases in the emerging world due to the sharp rebound in demand and some supply constraints, write economists at HSBC led by Metri Das. Services inflation remains a key risk in travel-related activities, with supply-side bottlenecks showing up in elevated flight and hotel prices. If tourism continues to recover quickly across Asia, we may see this pattern spread elsewhere too, as strong demand for travel and recreation could keep some areas of inflation more elevated than central bankers would like, Das says. HSBC believes outbound tourist spending will rise sharply from Asian countries as the region sees rapid growth in the number of middle-class consumers in the next decade. They also expect a continued rise in tourists from China, the largest market for outbound tourists. After the country abandoned its strict COVID-era measures earlier this year, tourism still has room to fuel demand in the coming quarters and years beyond, adds Das. Das adds, however, economies with a higher share of GDP from tourism should be cautious about the challenges and bottlenecks such as geopolitical insecurity, staffing shortages, and a shortage of capacity for visitors. Data released on Wednesday was generally upbeat, lending credibility to Fed Chairman Jerome Powell's assertion that the U.S. economy could skip through the recession minefield relatively unscathed, despite the cold water the central bank keeps tossing at it. The Fed itself released its July industrial production report, which rose by a consensus beating of 1%. Economists anticipated lazier 0.3 increase, bouncing back from June's 0.8% decline. Digging below the headline, a 5.2% jump in autos, parts, and a 5.4% surge in utilities were the prime drivers, with an assist from 1.2% gain in finished products and a 1.1% rise in materials. Autos to the rescue once again, but the outlook for manufacturing remains bleak, writes Kieran Clancy, senior U.S. economist at Pantheon Macroeconomics. We see tentative signs of a rebound in survey-based measures of capital spending intentions, but even if the improvement is real, it will take time to translate into improvement in actual spending. Capacity utilization, a measure of economic slack, tightened by 70 basis points to 79.3%, rising from a two-year low. Groundbreaking on news. Homes increased last month by 3.9% to 1,452,000 units at a seasonally adjusted annualized rate. While the number landed a hair north of consensus, it marks only a partial rebound from June's downwardly revised 11.7% plunge. A 6.7% jump in single-family projects as home builders scramble to fill a demand gap left by a dearth of pre-owned homes on the market, provided the elbowed grease to the upside. The need for new single-family homes, which is driven by scarce existing home inventory, should keep a flow under single-family construction, writes Nancy Vanden Houten, lead U.S. economist at Oxford Economics. Building permits among the four The more forward-looking housing market indicators act out at 0.1% gain to 1,442,000 units, falling 1.4% shy of analyst expectations. The could be worse, could be better tone of the Commerce Department's report echoes the National Housing Home Builders Sentiment Report on yesterday, which faded from optimistic to neutral. The latest back up in mortgage rates to near 7% led to a decline in home builder sentiment this month and points to some downward pressure in the sector. I'm glad you brought that up, Miss Houghton. The cost of financing home loans continued its hike up the mountain last week, putting yet another dent in mortgage demand in the process. The average 30-year fixed contract gained 7 basis points to 7.16%, the highest level in nearly 10 months. As a result, applications for loans to purchase homes softened by 0.3%, while refinancing demand slid 1.9% for a net 0.8% drop in total applications, noting that mortgage rates often mimic Treasury yields. Joel Khan, MBA's deputy chief economist, writes, Treasury rates were elevated again last week following mixed data on inflation and more indication of resilience in the economy, which may pose a challenge to the Federal Reserve's efforts to lower inflation. As illustrated below, where was I? As illustrated below, overall mortgage demand last week was 29.4% lower than the same week last year, while permits and purchase home applications are forward-looking housing indicators. They can't hold a candle to the stock market, which reflects where investors think sector will be 6 months to a year down the road. Through the lens, everything's coming up roses. Rebased on a year ago, S&P 1500 Home Building Index and the Philadelphia SC Housing Index have surged by 54.7% and 34.1% respectively, compared with the broader S&P 500's decidedly less impressive 3.1% advance over the same time frame. European fiscal policy likely to turn restrictive next year. Bank of America's European economists flag that 2024 will mark the start of tighter fiscal policy, with a rising risk of over-tightening that might trigger a mild recession. Despite Bank of America's indicator of Europe's macroeconomic environment implying a slight positive, the style cycle, which matches phases of the economic cycle with investment-style returns, remains in the recession phase. Quant strategies. Paulina Strzelecka says 2 consecutive months are required to move into a risk-on phase. She said, historically, there have been only 2 recession phases in which the indicator increased for the month 2001 and 2016, and in both cases it declined the following month. Bank of America notes, signaling a grim September. U.S. stocks churn, await Fed minutes. Wall Street's main indices are mixed early on Wednesday ahead of minutes of the Federal Reserve's July policy meeting that could offer cues on the bank's interest rate path, while shares of Target jumped on upbeat quarterly profit. The minutes of the July 26-27 FOMC meeting are expected at 2 p.m. Eastern Time. Ahead of the minutes, the 10-year Treasury yield is slipping back to around 4.21%. That said, if the yield holds above 4.1680, it will remain on track to rise for a 5th week in a straight row. The yield's October 2022 high was at 4.3380. On the data front, July industrial production, capacity utilization, and manufacturing output numbers came in above estimates. Target shares are jumping around 5% as its Q2 profit beat is overshadowing its forecast trim. With this, the SPDR S&P Retail ETF is gaining around 0.5%. The majority of S&P 500 sectors are higher, though chances are relatively modest. Energy is posting the strongest rise, up around 0.5%, while communication services is taking the best hit, off just around 0.3%. Here is a snapshot of where the market stood around 30 minutes into the trading day. Consumer spending showed a solid bounce in July, helped by spending on Barbenheimer, according to Bank of America. Credit and debit card spending per household rose 0.1% from a year ago, following 3 consecutive months of negative readings, according to Bank of America, while consumer spending returned to positive year-on-year territory last month. Spending around the 4th of July holiday online promotion, as well as spending on much-hyped movies Barbie and Oppenheimer, and to some extent on clothing, blasted consumption during the month. Bank of America Institute said in a report last week. Back-to-school shopping also blasted demand last month. Built-up savings buffer during the pandemic is helping households to weather higher inflation and has given them confidence they could withstand a modest economic downturn, Bank of America added. Indeed, data on Tuesday also showed U.S. retail sales increased more than expected in July as Americans boosted online purchase and dined out more. Most economists now believe the U.S. Federal Reserve is probably done raising rates, and they are increasingly warming up to the idea that the central bank too could steer the economy towards a soft landing rather than a recession they had been forecasting since last year. The S&P 500 index chart damage intensifies. Traders eye the next support. The S&P 500 index has now sold off as much as 3.8% from its July 27 intraday high into its August 15 intraday low. On Tuesday, the benchmark index violated an important level by ending below its 50-day moving average for the first time since late March. Action has traders eyeing the next support in an attempt to isolate areas where the S&P may attempt to stabilize. The S&P closed on Tuesday at 4,437.86, putting it below its 50-day moving average. That said, the index did end just slightly above the support line from its March trough. This line should ascend to around 4,434 on Wednesday, putting it just above Tuesday's 4,432 intraday low. Although the daily RSI ended Tuesday at 335.707, or its lowest level since the S&P March, it has yet to reach oversold territory. The next support for the S&P is below 4,432 is at 23.6 Fibonacci retracement of the March-July advance at 4,418. There is weekly Gann line, which now resides around 4,400. Gann lines are trend lines running at certain angles of significant highs and lows. The July 6th low was at 4,385. Breaking this level can suggest potential for a much deeper decline, with the next cluster of support in 4,328 and 4,302 area. Closing back, the 50-day moving average should ascend to about 4,550 on Wednesday. Can look constructive, but hurdles remain. Since breaking below the upper boundary of the 78.6% Fibonacci retracement zone of the January 2022-October 2022 decline at 4,534 on August the 2nd. S&P attempted but failed to close back above this level. So basically, guys, what they're saying here is that the US economy is still doing pretty much good. GDP has risen, even though it's risen by a minimum amount. So is jobs. Jobs are also on the rise, and so is consumer spending. So that leaves the door open for more rate hikes. But the Fed did say yesterday that it's going to depend on the data. But economists are expecting the Fed to hike two more times before the end of the year, and then going into 2024, they will decrease those rates again. There you have it, guys. Post FOMC analysis. Please do share this information with other traders as well. Thank you, and don't forget to like and subscribe.